Hello, credit union executives. Welcome to See You on the Show, where we give you up-to-date information on how you can reduce risk, keep key talent, and take a strategic approach to your personal financial wellness. Hosted by me, Doug English, a certified financial planner and former credit union insider with ACT Advisors. Welcome, everyone, back to See You on the Show. Today, we are delighted to have Michael Bell with us. Michael is chair of the Financial Institutions Practice Group at Honigman. He's also a driving force behind credit union mergers and acquisitions. Today, we're going to talk about M&A and some of the increasing activity with credit unions buying banks and uniquely strategies with the charter for your credit union. How there are some very unique ideas that Michael has that can position your credit union for explosive growth in membership and potentially in mergers and acquisitions. Listen in. Michael Bell, welcome to the show. I'm delighted that you've joined us today. I've been a fan of your work in the credit union movement for a long time, and I'm excited for our discussion today on charter strategies and non-organic growth.
I am too. I'm glad to be here, Doug, and I look forward to maybe talking about some things that folks maybe haven't given much thought to or weren't aware existed. I hope to cut some new ground today.
So let's start out finding out how you got to work in this wonderful movement. You know, a lot of people have an emotional connection to the way this movement takes care of families. So tell me your story.
Yeah, Doug. So look, I was born, raised in a town of about 5,000 people in Southwest Michigan. This is where it starts. My mom was a public school teacher. And when I was a young man, I don't know if I was 10, 11, or 12, she took me to United Federal Credit Union and I opened up a youth savings account. And that's truly where it started. Flash forward to when I'm 24 years old, graduated law school, and became a brand new baby lawyer in that very same town with my dad's two best friends, right? So a firm of three of us. The gentleman that was at the credit union when I opened my account was at the credit union running it at the time and was kind enough to consult with me on small legal matters. And then some time went by, flash forward 5 or 6 years, my relationship with them grew. And then we did something unique that had never been done before. In 2010, we purchased a bank, and that changed the trajectory of my career and my life, and credit unions essentially became the sole focus of my work.
Awesome. Another credit union win story. I love that. And I love the subject of credit unions buying banks, saving bank customers. That is one that I'd love to talk about. And that leads us right into the non-organic growth subject. So what we're looking for on this podcast is always bold ideas to help the credit union movement as a whole move in a non-linear way to really kind of explosively grow. And of course, buying banks and bank branches and ancillary businesses fits right in that area. So talk to us about what the opportunities are, how to know when you want to pursue those things, and especially in today's times where deposits are expensive and hard to come by, what moves make sense in this environment?
To start at the beginning, I think that, you can talk about credit union growth and there's organic growth, just to put the term out there, which is kind of internal to the credit union, right? It's what you're doing year over year with your products and your already existing business machine. And then there's this non-organic growth, which, as it suggests, is growth that's different. It's actually growth that comes from outside of you. So I think for many, many years, and perhaps even today, many credit unions feel like non-organic growth means one thing, and that is combining with another credit union. I think it's a fine idea. I'm not negative on that in any way, but I'm here to say that actually there's 3 more things on your list, right? It's a list of 4, not 1. And I want to be sure people understand that strategically you could acquire, a whole bank. You could acquire bank branches full of customers, loans, and deposits, and employees, by the way. Or you could acquire a whole host of other things depending on your strategy: investments, insurance, title insurance, specialized lenders, real estate, you name it. Banks and credit unions are in all sorts of businesses that are next to the lending and deposit taking function, right? It can cross all boards. So my point to credit unions is I'm not saying you should do this, but I am being unequivocal in saying you should consider this. So the wrong answer is to ignore it. The right answer is to get the facts and consider it and then decide yes or no. No can be the correct answer all day long, and I love it. Yes can be the correct answer all day long. I love it. Again, the wrong thing to do is to not pay attention, not consider it, and not have that opportunity to say yes or no. That's the risk.
What is the starting point that causes the thought to begin to exist for the board or for the leadership of the credit union? What's the beginning of going down the path of non-organic growth?
If I'm not mistaken, most, if not all, credit unions conduct some form of a strategic planning. And in that strategic planning, often there's some form of that where they'll talk about mergers and acquisitions or non-organic growth in some form or fashion. It's at that moment that often, I'm not a strategic planner, that's not my job, but often me or someone like me will swoop in for an hour or hour and a half and say, all right, here's the deal, A to Z. This is what you can do. And it's in those moments that credit unions can then maybe think it through and consider, is this a strategy for us or not? But that's really where it starts. It's that pre-planning. And I'll tell you, just to be clear, an earlier point you made, these items are relevant regardless of the cycle we're in. So we've been doing this for 15 years during liquidity crunches, during when we were flush with liquidity and needed loans. This is applicable in all markets. And I'll tell you, for the most part, it's very relevant right now because two main reasons. Through no fault of anybody, politics aside, it's really hard to be a small bank today. Okay, just like it's hard to be a small credit union. I'm not saying either of those are bad, they're just hard to be. So there's a lot of people there that are ready to exit. But then layer into that an interesting generational fact. So if everybody looks around and you look at the color of the hair on the owner of the bank, it's gray or it's gone. If you look around and look at the color of the hair at your local investment shop or your local insurer or the title insurance company, I'm going to guess it's gray or it's gone. So generationally, at this moment, I've seen this happen about a year ago, and it's really kind of firing up. Many people are retiring. Many people are looking for that exit where they'll get the equity they've had tied up in the business forever and move on to the cruise ship. So this is exceptionally relevant at the moment for economic and generational reasons.
But what's behind it is strategy. It's an overall part of your strategic plan for growth to add these ancillary businesses if you're talking about a new business, or it's part of your expansion of your footprint, right, if you're buying a bank.
Yeah, so Doug, that's right. So look, I think there's maybe 10 or 20 different components that could kind of drive these. If I look at all the credit union clients I have and the reasons they did these things, I think there's maybe 10 or 20 reasons. But I'll tell you what, there's 4 that I think are present in every transaction, the big 4. So look, we're in a geographic business. You even said the word because you know what you're talking about. Geography always matters, right? FOM matters, geography matters. So regardless of what we're buying, there's always a geographic component in there somewhere, okay? Second, it's certainly about scale, whether it's for assets or liabilities, loans or deposits or non-interest income. Put that in a bucket. This absolutely has a scale component and is very much about gaining pieces or portions of additional business. Third, it's always about talent and capabilities, whether that's people or technology. So we're often, whatever we're buying, we're going to get a gain somewhere in there. A lot of times it's both spots where we're going to gain some capabilities we didn't have, and we're going to gain some people, some great bank or business trained talent that we can use. And then the fourth thing really is more of an accounting thing, but it's relevant. So in these transactions, the way the accounting works with purchase and acquisition, mark to market, fair value, those are the words you're going to hear. They are revenue positive on something called LD1. What is LD1? That's legal day one. That's the day after we close. So whatever we buy here, the next day it's revenue positive. And I raise that, and credit unions have noticed that because a lot of things in your business are not revenue positive on LD1. I'm not selling you anything here. There's just a difference to what you're normally used to doing. If you go out and buy a piece of real estate and build a branch, I guarantee you it is not revenue positive on day one. This is different. So you take those four main things, you add in other individualized things, right, for each credit union, and there you have it. But those are the big four.
The ones that I see the most from your LinkedIn posts as well as others tend to be the ones closest to the credit union's core operations, right? Which is buying banks, buying bank branches. But then these ancillary ideas, buying investment and insurance firms, remind me of what I've heard in fintech, right? In partnering with a fintech, you can either buy the technology or try to develop it yourself. For most credit unions, without massive scale, the core competency is just not there. So it makes me wonder: is that the what's behind buying an investment firm or buying an insurance company? Is it that you're immediately acquiring those core competencies, but then is there a track record of credit unions being able to run those things as effectively as they run their core business?
Yeah, so more often than not, the purchasers are in that business in some form or fashion. This is considered an add-on or a bolt-on. But I will give you a different example. They're not in the title insurance business, and we buy title insurance companies all the time. But when you buy these things, you obviously retain the talent, otherwise you're not going to buy it. And so there are ways to assure that we're going to be able to optimize and maximize and run the thing. That's the truth. The people and the capabilities are always very important. They're one of the big four.
Especially in today's world, right? Let's shift directions and talk about charter strategy. This is an area I think is really, really interesting as far as state versus federal and what type of federal charter. So can you go back to the beginning of when does a credit union begin to think about that kind of an issue? Like, is that another thing that comes out of the strategic planning session, or does it come somewhere else?
I think that charter choice or charter examination really needs to be a part of a strategic planning session, even if it's just looking at the options and reaffirming that you have the best one for you. Boy, what peace of mind is that, right? There's not risk in it. People I see are sometimes nervous, like, well, I don't want to change my charter. That's not what I'm saying. What I'm saying is, as a part of the planning process, just examine it. And the answer you may get back over half the time is, you're in the right spot. Good job. That's not a bad answer. But yes, Doug, it's definitely a front end strategic consideration. And then once we dive into charters, and we can do that whenever you want, I will tell you I have a very strong bias, and I admit it.
I want to hear all about it. I want to hear what is going to make the biggest difference for the credit union movement. So let's hear about the ultimate ideas for how you might evaluate your charter, and then what is the place that positions your credit union for the most potential growth.
Yeah, so we have what's called a dual chartering system, right? We have state charters and we have federal charters. And then within the federal space, we have a few different types of charters. That's kind of our menu. I will tell you that I think there are many states, many, that have excellent, strong, lovely charters, right? So I'm not anti-state charter in any way. There are many that have some pretty good ones. But I will tell you that I think the best, the optimal, for growth, for scale, for effectiveness charter that exists today is the federal multiple common bond charter. And if it's possible to pair that with a low income designation, and maybe even do a little CDFI if you're allowed to open yourself up for some other benefits, you kind of have it completed at that point, right? I think that's the greatest, the biggest, and the best tool for growth and scale. And it's interesting, Doug, because I think people have this idea that, well, federal community, right? It's easy. You get counties, and anybody that lives there, they're your member.
That was my perception. Until this call, that was my perception.
Yeah, and that's true. But that's a limited charter. That limits you to a certain population area, to a certain area of counties, and you will forever be limited. There are no exceptions to that, right, for the most part. The federal multiple common bond, on the surface, you think, well, wait, what? I have to have a SEG? What's that? I have to sign up businesses? I don't know. But what I will tell you is a properly done federal multiple common bond charter involves a multitude of items, certainly select employee groups, but it also involves something called underserved areas, which, by the way, are pieces of geography. It also involves associations, charitable type things, depending on the details. Combine that soup, and you will far exceed a possible pool of members than any community charter I've ever seen before, right? It's not even close if you have a proper and effective federal multiple common bond charter. And let me tell you what, Doug, I think some people, once they see what you can really have, almost feel guilty about it. And they're like, wait, is this legal? Is this okay? I thought we're supposed to have a restricted FOM. And the answer is you do, and it is okay. It's just a heck of a lot bigger than any sort of community FOM you would ever get. That's the truth.
It's ringing my too good to be true bell that it's possible to do that. So I know that you have taken many credit unions through this evaluation and down this path. So talk to me about what are their characteristics that the leadership is looking for that causes them to end up in this direction. And then let's talk a little bit about the path to get there.
I will tell you, it is about growth and scale and ease of adding new members and serving new members. I mean, I'll give you an example. I'm not going to name names or give any secrets away. There's a credit union I represent that's federal multiple common bond, and they're in 5 different states. None of those states are contiguous. You could never do that with a community charter. It's absolutely impossible. They went to those states for many reasons, some historical, some through merger, some through other opportunities, but they had the freedom to do that. And it's been successful for that credit union without question because they've had the federal multiple common bond charter. Now, here's the good news, in my opinion. Looking at the charter options for you is not like pre-calculus. It doesn't cost millions of dollars. It's not painful. Nobody's making you do anything. It's a pretty easy science to say, all right, here's what you have, and here's the maximum amount you can do there. And here's what you could get. And the maximum amount you could do there. It's not a painful exercise, and it is rather factual. There's many vendors out there that do such things. Multiple vendors that I think do a great job. I've seen their work product in this very regard. Let's say if there's 2 messages from the podcast today, they have a theme here, Doug. 1, I'm not suggesting you must do this or that, but I am suggesting you will be remiss and not doing your job if you don't, 1, just simply examine your charter and what your options are, and 2, simply examine what non-organic growth is open to you and what your options are. Then it's up to you to decide. The key here is to examine it and get the facts, period. I have been in front of plenty of wonderful, lovely, successful credit unions where we've examined one of these things or the other. I felt compelled that it was a great idea. They didn't, and they told me why, and I said, actually, you're right, good. And we left it at that. There's no harm in that. In fact, that's a win. I've also been in front of plenty of lovely, successful credit unions where we've done it. They're like, yeah, this is right for us. We're going to do it. We did it. And the course of their existence changed dramatically and materially, and they're far more successful today than they were before. It breaks both ways.
How long does it take to go through that process? And assuming that you decide you want to make a change, talk to me about that process.
I think the process to analyze your options, it's 30 to 60 days. This is not laborious. It's pretty quick to look at what you can do under various different charters. This does not take long. Second, it's going to depend on the details of your situation, meaning, if you're a state charter, states have processes and procedures for you to flip to federal. The federal piece has a process and procedure to accept you. It involves a member vote, right? Now everybody just got nervous, Doug, but it's okay. Member votes aren't evil. You can do them successfully, right? So let's stay calm.
I think everyone just hung up, Michael. I think we just lost all of our listeners.
I will tell you that most of the time, the charter change process would happen quicker than you necessarily wanted to, and you will have control of the timing just to make it work for your organization. Another thing to understand is this is not a runaway train. You can go through the process, be released by your state, be accepted by the feds, and then pick when you're going to push the button. This is not something that's like you let it loose, it's a Leviathan, next thing you know, you're federal and you weren't ready for it. No. You can go through the whole thing and then ultimately decide to push the button, or by the way, ultimately decide not to and stay where you are. Yeah. So let's relax that fear. Let's just focus on this scary member vote thing that's going to make everybody's hair fall out.
So do you have any data on when this kind of thing goes to member vote? Does it pass all the time or most of the time? Or when does it get where you regret that you ever brought it up?
Yeah, so I can only speak to personal experience I've had. And I can tell you 100% of the charter changes that I'm aware of, been involved in, my clients have done, have passed. It's a pretty high number. Now, look, some could have failed, Doug. Full disclosure, I don't know. I don't think those things are necessarily publicized or tracked. all I can speak to is my experience, over the last 15, 20 years and tell you I've never seen one fail.
We get into analyzing executives' split dollar plans and kind of how they work together with the rest of their finances. And some of those plans have change in control provisions in them. Do they trigger on a charter change?
They do not. I'm glad you asked, Doug. Operationally, I don't think your members notice a thing. I don't think your team necessarily notices a thing. This is really about future growth. And do we have to manage some things regarding the new federal bylaws and policies? And are there little things to deal with for the compliance folks that we help with? You bet. But operationally, the day you switch, no one's going to notice a thing. It's just not an issue that affects that kind of thing. It's really about future growth options, FOM expansion, and other things that come down the line.
I bet there is some emotionality with the original founders of the credit union worked at the paper mill or worked at the telephone company. And this was the telephone company's credit union. And now it's becoming a much larger, broader organization and losing its soul. Do things go like that?
I think that question gets asked more when we talk about things like name changes and mergers, and that emotional piece is always there. I think there are tools there to help solve that. We've come up with a lot of strategies to honor and protect that history in mergers that I'd be happy to talk with people about. But I think that's there. I think it just comes up in a different way, not necessarily in charter change or if we're ever going to acquire anything, because that history doesn't change based on those items.
And is there a charter optimization beyond the change? Is there something else that you do with your charter besides changing it? And if so, what is that?
Yeah, you bet. So once you change and once you are multiple common bond, I absolutely believe that somebody on your team has to own that, right? Has to own your FOM, and that you are continually expanding it. It is something that you babysit, you water, you fertilize, and you let grow. And it doesn't happen without you, and it doesn't happen by accident. So the best institutions I work with have a person or people that own the FOM, that are consistently looking at it, finding opportunities to expand it and nurture it and make it as dynamic as possible. It's an ongoing annual exercise, just like other parts of your business that if you just leave alone, they're going to die. So there is a continuing strategy without question.
For a federally chartered credit union that has a community charter, how different is the multiple common bond charter than the community charter? The difference is that you don't have the geographic limitation. Is that the net of the difference?
Yeah. So, that's one of the key differences is you're not bound by serving the population in the area that is sharply limited by a community charter. That's for sure. But understand what I'm saying to you, in a multiple common bond charter, you still can get geography in your charter through underserved areas. So, there's perceptions that need to be cleared up here. It's different. But in the end, I believe, like I said, there's some wonderful vendors out there that have white papers that kind of prove this as fact, that you can have a much larger possible membership under that charter.
So let's say that our listeners want to read some of that wonderful white paper. Where would they go? You give us some resources and things that they could go and read?
I don't mind saying that I think there's two vendors in this space that really are cream of the crop, and that is CU Collaborate. They have reams and reams of white papers. And then I think Dollar and Associates, right? Dennis and Kirk, both of them, I believe, have the pulse of the FOM situation and very much understand federal multiple common bond charters and have great information out there on them. I would consider those two vendors to be cream of the crop.
I had a great conversation on this podcast with Sam Brownell about some of the incredible creativity that he is leading that organization with.
Doug, we have an exceptional amount of mutual clients. So you're not surprised that credit unions that are working with CU Collaborate or Dollar Associates are the credit unions that are working with me. This message transcends that. And it's clear that we're not doing anything illegal, anything untoward, but we're definitely pushing envelopes and growing and doing big things because you can. No one's taking naps at these organizations.
I love it. Awesome. Thank you very much for your time, for your ideas, for your assistance in pushing this great movement forward. I love to see bold thinkers in the credit union movement helping this great industry to grow. Michael Bell from Honigman LLP, thank you so much for our conversation today. I'll look forward to seeing you out there in the credit union movement.
Thanks, Doug. Same.
That's all the insider credit union knowledge we have for this episode. Are you enjoying the conversation? Be sure to subscribe and share your thoughts with other credit union leaders by leaving us a review. See you next time on See You on the Show.
The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual security. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Economic forecasts set forth may not develop as predicted. All performance referenced is historical and is no guarantee of future results. Indexes are unmanaged and cannot be invested into directly.